What's going on, money lovers? Welcome back. So I've been talking a lot about individual companies lately, and I wanted to take a step back and talk about one of the most important investments you can make, and that is in an index fund. Index funds are the easiest, most passive, guaranteed way for you to build wealth. Everyone should own index funds, especially if you're a new investor. If you're a new investor, you should not be buying these individual companies, all the stuff you're hearing in the news. Anything you hear them talking about, you want to stay away from. And you should be putting all your money into an index fund because it's the safest and most guaranteed way that you will make money over the long term. Think of an index fund as a basket of stocks. So if you were to buy VTSAX, this is a total market index fund, instead of buying into companies individually, you would buy this one ticker and own all of these companies, all 3,597, Apple, Microsoft, Amazon, and you own them by their weightings. So as you can see here with VTSAX, you would pay for one share of VTSAX $94.43, and you would own, here are the top 10 holdings. You would own all these companies. 5% of your money would be allocated to Apple, 4% to Microsoft, 3.6% to Amazon, and so on and so forth. So instead of dishing out $3,000 a share to buy one share of Amazon, you could buy one share of Vanguard and have exposure to Amazon. Now, these are the top 10 holdings, which make up over 22% of the fund's total assets. I'll link this in the description below, but here's a complete list of all the holdings. And as you keep going, you see you've got Berkshire, JP Morgan, Procter & Gamble, Walt Disney, Nvidia, lots of great companies. You own them all in one place. It doesn't get much easier than that. Now, this approach is great for everyone, whether you're brand new to investing, especially if you're brand new to investing, whether you have experience, whether you pay attention to the stock market or you don't. There is a place for these types of index funds in everyone's portfolio. As you can see here in the chart from 2000, over the last 20 years, we've had some dips and a couple crashes, but overall, had you just held on, done nothing, kept your money in here, you would continue to make more money. So even though I am an active investor, I invest for the long term, and I do pick a lot of individual companies, but I always am putting money into an index fund as well. I have automatic investments that I make every month. Money comes out of my bank account, whether it's $100, $200, and it goes into this index fund. Vanguard's Total Market Index Fund, VTSAX, is one that I own. I own a couple others. This is a foolproof way to help you match the market's returns, which over time tends to be around 10% a year. And in a minute, we'll take a look at how much money you end up with if you just do that. You don't have to do any research. You just have to automatically put money away, dollar cost average in. Like I said, I like to do it once a month. After I get my paycheck, I make a deposit. This protects you from putting all your money in right at the wrong time. Let's say you put all your money in '08 and everything crashes. Instead, you dollar cost average. So you put some money in here. Each month, when it bottoms out, you put more money in, you keep investing regularly, and you keep making more money. As you can see, here's VTSAX performance, and every brokerage has their own version of this. Just look at whatever brokerage you have, whether it's Fidelity, Schwab, they have a total market index fund, which should have basically the same returns. So this 5-year average return for the total market is nearly 11%, 10.95%, and its 10-year return is even better at almost 14%, 13.78%. As you can see, here's how it performed each year. 2020 made almost 21%, 2019 over 30%, 2018 it lost 5%. So there are a few red years, but as you can see, the green far outweighs the red. If you had been investing since 2001 and you invested continuously, you put in the same amount of money each month, despite all these ups and downs, you would be way ahead of the game and you would be doing very well right now, having made 50% in the last 2 years alone. Now, there are lots of different types of index funds. I'm a fan of the total market index or S&P 500 index funds. We've probably heard of SPY or VOO, VOO. These are both S&P 500 index funds, which do the same thing as that total market fund, but they only own the 500 companies of the S&P instead of only 3,500 different companies. They tend to perform about the same. Now, if we compare that to VUG, Vanguard's Growth Index, you'll see something similar. The funds have gotten very similar and comparable returns, as you can see. The Growth Fund has slightly outperformed the total market fund with 16.66% return over the last 10 years. And as you can see, if we compare the top 10 holdings, this is VUG or the Growth Fund. The top 10 holdings are the same, but the weightings are different. So with the Growth Fund, 11% of your money is in Apple versus only 5.3% in the regular index fund. And this trend continues. Microsoft 9%, Amazon 7.5%, versus with the regular fund, you have half that exposure to these companies. So this can work for or against you. Over the last 5 years, FAMGA, Facebook, Apple, Microsoft, Google, Amazon have far outperformed the market. They've gotten very good returns, but who knows what the next 5 years hold? Maybe over the next 5 years, these companies will not do as well. I believe they will keep growing, but once you reach the size that they currently are, it's very difficult to continue to grow your company 30, 50% a year. Like we just saw with earnings, Microsoft, certain segments like their cloud revenue, I believe, was up 50%. But overall, it's very difficult to grow at such enormous clips when you get to this size. And that's why you see these companies starting to pay dividends. Apple and Microsoft have a small dividend they have instated. At the end of the day, you would do pretty well regardless if you bought the growth fund here or the total market fund. Now, if we look up VOO, VOO, Vanguard's S&P 500 index, same principles apply, except you would only own the 500 companies of the S&P 500. So the top 10 holdings tend to be the same for the most part. If we look at VOO's performance, it's around the same 14% over the last 10 years. So it's within a few percentage points, but these should be staples in everybody's portfolio, especially if you're a new investor. Because if you put $1,000 in some random company that you think is the next big thing, even if you do hit it big, let's say you hit it out of the park, so now you've made 100% return, you turned your $1,000 into $2,000. But there's a lot more risk than reward. Whereas when you put your money in the index, you're going to make 10% a year. Your money is going to start to compound. And let's just take a quick look. If you know me, you know I love to use the compound interest calculator. You'll see over time what the possibilities are. And if you don't know what compound interest is, I'll link this in the description below, but it means that the interest you earn each year is added to your principal, so the balance doesn't merely grow, it grows at an increasing rate or an exponential rate. Compound interest is one of the greatest things. All you really need to know is, so if we see what this looks like in actuality, let's say you're starting with 0, and every year you plan to add $10,000. You give yourself 30 years to grow, and like I just showed you with VTSAX, last 5 years it's earned almost 11%. We'll be conservative. You can expect statistically the stock market will go up on average about 10% a year. That doesn't mean every year it's going to go up 10%. One year could go up 30% as we saw. Another year could go down 35%. But in the long run, it's going to grow 10% annually on average. So what do you think you end up with? Putting $10,000 away for 30 years and earning 10% interest on that money each year. You said anything less than $1.8 million, you're wrong. And the more time and money you increase this by, it increases exponentially. So had you put $15,000 away for 30 years, you made $2.7 million. If we up this to 40 years, you made $7 million. You see how over time, time is your best friend and it's also your enemy, because the sooner you start, the better. The longer you wait, it's harder to catch up. But if you give yourself a big enough runway, you have a long time horizon ahead of you, you will become a millionaire. So that's a bit gist of what you need to know about index funds. The VTSAX pays a small dividend yield of 1.4%, and I like to reinvest that dividend yield as well. That's also included in the total return. So if it said it earned 10%, it earned 8.6%, let's say, plus this 1.4% dividend. I don't want to complicate it, but index funds are the easy, most hands-off, passive approach to building wealth that exists. They are a gift and everyone should take advantage of these. Even though I outperformed the market last year, I got a 240% return. Not going to happen every year. I don't even expect, who knows, this year I might not even get a 20% return. I got lucky and I accept that and I don't let it get to my head, and I continue investing in index funds, and I also do like to invest in individual stocks. You may or may not, but there's a place for index funds in everyone's portfolio. Let me know what you think in the comments below. Do you own any index funds? If you have any questions, let me know. This is Vinny from the Investment Club, and I'll see you next time.